Hello friends, I hope you have a nice day. In this video, we will talk about risk management and money management in both personal and funded accounts. Risk management and money management are essential concepts in trading that aim to minimize potential losses and maximize profits while maintaining a disciplined approach to trading. These two aspects are crucial for any trader's long-term success and survival in the financial markets. 1. Risk management. Risk management in trading refers to the process of identifying, assessing, and mitigating potential risks associated with trading activities. The primary goal of risk management is to protect your trading capital from significant losses that could potentially wipe out your account. Here's a breakdown of the key components of risk management. Position sizing. Determine the size of each trade based on the amount of capital you're willing to risk on a single trade. The general rule of thumb is to risk only a small percentage of your total trading capital on any given trade, typically between 1% to 3%. This way, even a series of losing trades won't severely impact your overall capital. Stop-loss orders. Implement stop-loss orders for each trade. A stop-loss is a predetermined price level at which a losing trade will be automatically closed. It helps limit potential losses by ensuring you exit a trade before losses escalate beyond your comfort level. Risk-reward ratio. Determine the potential reward relative to the amount you're risking on a trade. For example, a common risk-reward ratio might be 1 to 2, meaning you're aiming for a profit twice the size of your potential loss. This ratio helps ensure that your winning trades can offset your losing trades over time. Diversification. Avoid concentrating too much capital in a single trade or a single asset class. Diversifying your trades across different instruments or markets can help reduce the impact of a significant loss in any one position. Risk tolerance. Understand your own risk tolerance and emotional capacity to handle losses. This awareness will prevent you from making impulsive decisions during periods of high market volatility. 2. Money management. Money management is a broader concept that encompasses various strategies for preserving and growing your trading capital over the long term. It's about maintaining consistency in your trading approach and ensuring that your trading decisions align with your overall financial goals. Here's a breakdown of the key components of money management. Trading plan. Develop a comprehensive trading plan that outlines your trading goals, risk tolerance, strategies, and criteria for entering and exiting trades. This plan provides a roadmap for your trading activities and helps you stay disciplined. Capital preservation. The primary objective of money management is to preserve your trading capital. This means avoiding excessive risk-taking and reckless trading decisions that could lead to substantial losses. Compounding. Compound your profits by reinvesting a portion of your gains back into your trading capital. Compounding allows you to gradually increase your position sizes as your capital grows, potentially accelerating your overall profitability. Consistency. Stick to your trading plan and avoid making impulsive decisions based on emotions or short-term market fluctuations. Consistency is key to long-term success in trading. Periodic evaluation. Regularly review and assess your trading performance. Analyze your trades to identify patterns of success and areas for improvement. Adjust your trading plan and strategies based on your evaluations. In conclusion, risk management and money management are fundamental pillars of successful trading. Implementing a solid risk management strategy helps protect your capital from substantial losses, while effective money management strategies ensure consistent and sustainable growth over time. Remember that trading involves inherent risks, and no strategy can guarantee profits. However, a well-executed risk and money management plan can significantly increase your odds of long-term success in the markets. Certainly, risk management and money management principles apply to both personal trading accounts and funded trading accounts. However, there are some differences in how these concepts are approached depending on whether you're trading with your own capital or with funds provided by a third party. 1. Personal account. When trading with your personal account, you are using your own capital and are solely responsible for your trading decisions. Here's how risk management and money management apply to personal accounts. A. Risk tolerance. Understand your personal risk tolerance. Determine how much of your own capital you're willing to risk on each trade. This is usually a small percentage of your total capital, typically between 1% to 3%. B. Position sizing. Calculate the position size for each trade based on the percentage of capital you're willing to risk and the distance from your entry to your stop loss. This ensures that a single losing trade doesn't have a significant impact on your overall capital. C. Stop loss orders. Set stop loss orders for each trade to limit potential losses. Make sure your stop loss level is based on technical analysis, support/resistance levels, or other relevant factors. D. Diversification. Spread your capital across different assets or markets to reduce the impact of a loss in any one position. Diversification helps mitigate risks associated with specific assets or sectors. E. Emotional discipline. Stick to your trading plan and avoid making impulsive decisions driven by emotions. Emotions can lead to irrational trading and negatively affect your results. F. Consistency. Maintain consistency in your risk management approach. Avoid increasing your risk per trade after a string of wins or losses. 2. Funded account. A funded trading account refers to a scenario where a third party, such as a proprietary trading firm, provides you with capital to trade. In this case, you're trading with someone else's money, and there might be specific rules and requirements to follow. Risk limits. Funded accounts often come with predefined risk limits set by the funding provider. These limits might specify the maximum loss allowed per trading day, week, or month. B. Performance targets. Some funded accounts require you to meet certain profit targets within a specified period. This helps ensure that traders are consistently profitable and can manage risk effectively. C. Profit sharing. In many cases, funded account programs involve profit sharing. Traders receive a portion of their profits while the funding provider retains a percentage. D. Account rules. Comply with any rules or guidelines set by the funding provider. This might include specific trading strategies, risk management protocols, and reporting requirements. E. Capital preservation. Despite trading with someone else's money, capital preservation remains crucial. Your goal is not only to meet profit targets but also to avoid losses that could lead to account suspension or termination. F. Evaluation and progress. Funded trading accounts often involve periodic evaluations of your trading performance. Regular assessments help ensure that you're adhering to the rules and maintaining consistent profitability. In both personal and funded trading scenarios, risk management and money management are essential for maintaining discipline, protecting capital, and achieving long-term success. The key is to tailor your approach to the specific circumstances of your trading environment while adhering to the core principles of risk and money management. If you have money, meaning $10,000 or more, you can look for a good broker and put the money in it. The more money, the better. If you only have $100, brother, take a funded account because it is only $100. You will lose. You can succeed, but you need to be an expert in the financial markets, and the risk rate remains high, so I say that the best thing is a funded account and strict management of the capital. Money management and money management. Personally, I work in a funded account and my risk management is very strict so my brain can put that together. The maximum daily loss is 1.5% and make 2 trades per day, or a maximum of 3 trades each. Dealing 0.5% if economic news 0.25%. We have reached the end of the video. This was my risk management, and the difficult thing is to discipline it for a long time. Remembering trading takes time to get rich. You cannot be rich with one deal. There are years of work and discipline to achieve success in this field. In the next video, we will talk about psychology. See you soon.